And in Australia, a couple indicators out this week on inflation trends expected to have an impact on the markets. We've got PPI, or wholesale prices, out today, expected to come in at half the prior reading. We're looking for 0.8% annualized versus 1.6 in the last quarter. And midweek, what is this, 23rd, 24th, 25th midweek on Wednesday, the CPI reading expected to show a lurch to just 0.7% for the third quarter against 1.6% in Q2. What implications are there for the RBA, the Reserve Bank, and rate-sensitive industries like properties? Joining us from Sydney today is Brad Piltz, CEO of Landmark White, one of the major valuation and property consultancies in the Land of Oz, and the only listed one among them. Brad, welcome to the program. First of all, let me ask you about inflation trends, what you're expecting from the RBA, and how that all comes together and affects what you do.
Yeah, well, we guess that CPI, of course, the figures will come out this Wednesday. The current CPI sits at about 4%. We would see that CPI will probably come off a little bit there. The petrol prices have come down. That'll be a significant influence on that. So the CPI should come off marginally. I don't think there'll be any real reason for the RBA to lift interest rates when they meet next week. The general consensus is then that there could be reason in December, but generally, as it gets close to Christmas, that's not what they do. So we'd expect an interest rate rise probably in the first quarter of next year now. What that means for property, well, depends on the sector we talk about.
Okay, well, let's take residential, since there are more people involved in residential than in anything else. Right now, with the current rate environment, is it net positive, net negative for people either taking out very short-term adjustable money or longer-term commitments on mortgages?
Yeah, well, I think the general trend would be that's certainly going to be negative. We've got, if you like, at the moment, the average amount that any household pays on a mortgage throughout Australia is very high. It's about 32%. And now that varies from state to state. We've got Western Australia, which is going through a resources boom. It's down about 30% of total household income on a mortgage, up to New South Wales, which is about 37%, which is very high. So generally households won't have and don't have capacity to pay a lot more in mortgages. So any increase we see will significantly affect property values. Now, at the moment, as you go from state to state, it's a bit different. In New South Wales, the property market is severely being affected. We're still seeing values across the board come off. Some of the prestige market is still relatively strong, but even there you've got to differentiate between an homogenous, if you like, if that's possible, prestige property, and that property that's in very well located, has strong location. It's still standing up, but only the rare ones. So there's still the market's coming off in residential in New South Wales. In southeast Queensland, we're starting to see it come off as well. So it's different around the country, but I really believe that because of the high amount of mortgage repayments with the disposable income at the moment in the households, an interest rate will see the affordability of houses continue to diminish.
Right. I guess if you're talking North Sydney, Milson's Point, Kirribilli, it's pretty much a homogenous kind of luxury market, very different out in Darlinghurst or Wollongong. Let me ask you one more question specifically on the residential side. Brad, there's sort of a polarized market. You mentioned WA because that's where all the mines and all the nickel and copper and stuff is, so obviously they're doing well there. But you also got Brizzy and places up north doing fairly well. New South Wales a little bit underwater. Maybe it's an affordability question, but what is leading to these dynamics? People don't leave Sydney to move to Brizzy because jobs are just as available there. I mean, how much migration is there? How much of this is actually tied to local job formation and the actual wage levels?
Yeah, well, Australia, of course, in immigration, looking forward, will take between about 80,000 and 140,000 people a year. While the majority of those actually land in Sydney and Melbourne, over time they move. And a lot of that movement is across the border north into Queensland. A significant part of what our market is at the moment is if you look at the population that's over 60, which is about 3.6 million, that over the next 10 years is going to end up at 5.4 million. So we've got a huge, if you like, the retiree market or the seniors market looking for lifestyle. And that's been a significant influence on that southeast Queensland, that Brizzy market. which is quite different to northern Queensland, which is trading off the resources boom. And up there we've seen some phenomenal residential price growth simply because there's just so much money flooding that North Queensland market. Southeast Queensland is still growing, but you'll find that residential prices there are starting to come under a bit of pressure.
Well, it's a beautiful part of the world, and if you want to go diving and see the Great Barrier Reef, I guess you have to be in Brizzy, and you can't really do it in NSW. What is going on in the commercial space? Let's switch gears for a second, Brad. Is there more interest, less interest? How much foreign participation in the Aussie boom? I suppose with the commodity cycle where it is, there's quite a bit of foreigners landing and interest in helping develop some of these resources.
Yeah, there is a lot of interest. You'd have to say, though, in general, the majority of offshore money coming into Australia lands in Sydney. We've seen very little, if any, in Brisbane. There's been very little activity in Melbourne. A German organisation has invested in Adelaide just recently, which is a bit of a surprise. We're finding that locally, the local companies, well, Bank West, for instance, have taken a huge commitment over there in Perth, again driven by resources. But we'll find, in general, the commercial market in Australia is at an all-time high in terms of values, quite in contrast to residential, which is not so unusual. When you look at the cycles, residential cycle generally falls before the commercial cycle. And at the moment, when you're buying some of the commercial properties, sub 5% yields, that's extremely strong. And so you'd have to wonder about the future for commercial property. Generally, in terms of value in commercial, people are looking at either yield compression, so yields drop, so values go up, or they look at rental growth. At the moment, with yields so low, of course, everyone's looking for rental growth. And then, well, not sure.
Okay. Brad, appreciate your time and all your insights into the markets. We'll chat soon. Brad Piltz joining us from Sydney. We'll check in with Darren Boyd on Hong Kong next.